My name's Brian Picker. I'm with Southern Trust Mortgage, and basically, I'm kind of here to help you guys understand VA financing, walk you through some different parts of it. At the end, I was going to do a kind of a Q&A, but if anybody has any questions in the middle, please feel free to jump in. I'm going to attempt to kind of keep it simple and just walk you through the process a little bit and educate you a little bit on VA financing versus maybe conventional financing, that type of thing. Um, so just to kind of start off, with VA financing, like any financing, has some pros and cons to it. So I'm going to cover that as well. First step with any type of financing, including VA, is really you want to get pre-approved. And where the pre-approval comes into play and is important is because when you're out looking, you basically, if you come across the house that you like, you want to be able to put an offer on it. And typically a seller is going to require a pre-approval letter, which just lets them know that, you are pre-approved financing wise for the house, that a lender's looked at credit, income, assets, that type of thing. So getting pre-approved for VA financing is relatively similar to any other type of financing, with the exception of what we do is we pull up we can get from VA, a customer can do it themselves. A lot of times we do it for the clients. We'll get your certificate of eligibility from VA directly. So when we start the pre-approval process in general, I usually will have a quick conversation, 5 or 10 minutes with the client, just kind of walk them through the process. With the pre-approval itself, my goal is to really help you understand budgeting is the biggest thing. I'm going to look at credit, income, assets. I try to find out from you if there's a certain price point you think you want to be in, certain area, a certain monthly payment you want to be around. A lot of times lenders, when they do a pre-approval, they'll come back and say, all right, you qualify for X amount, but that amount may be higher than what your budget is. So I try to more focus around your budgets, and then we work off of that. We can adjust up or down. So really I typically will have a client do an online application. That usually takes them about 5 or 10 minutes to fill out. It's just your real general info. That gives me a starting point. I give the client a list of supporting documents. So pay stub, W-2, bank statement, just very easy stuff. A lot of that stuff is so easily accessible now online, but that just gives me kind of the nuts and bolts for income and asset. There's a VA form that I typically will send out that the client will fill out and sign. That's the form that I use. We upload that to VA system to get the certificate of eligibility. I typically like to get that certificate of eligibility up front because it tells us some information in regards to the amount of eligibility, if there's an outstanding VA loan already, that type of thing. So any of you have ever dealt with VA, what will happen is VA tends to, if there's any errors or anything, they can take a while to fix it. So I always like to do the certificate upfront in case there is something that we need to get help with or getting fixed. It's kind of rare that happens, but it's just better to be safe than sorry. And then once I've kind of pulled credit, looked at income and assets, I'll kind of give the customer a call to walk the customer through closing costs, monthly payments, rates, and really just try to help everybody understand budgeting. If you say, look, I want my payment to be no more than $2,000 a month, I can help you understand, if you wanted it $2,000, you need to look at a sales price that's no higher than X amount. And just kind of walk you through that. And that really helps you set up your search so that you're looking in the right price point based on what your budgets are. And then obviously, if you can't find anything and you qualify higher, then we can always expand it a little bit. So that's just kind of in the very beginning to get things started so that the pre-approval really puts the buyer in a driver's seat. So even if somebody says, look, I'm not going to buy for 10 months, the earlier you do the pre-approval, typically the better, because there are plenty of times where a house may come on the market sooner than you expect, and you absolutely love it. And if you haven't started the pre-approval process, sometimes it can be the difference in getting that house or not, because if you're not ready and it's a Saturday night and deadline is Sunday morning, you may end up missing out. So I always encourage people to do the pre-approval as early as possible. And then from there, VA does have some different terms compared to, say, a conventional loan or an FHA loan. The two biggest things are one that I touched on, which is the certificate of eligibility. When we get that, it tells us the branch of the military they were in, It tells us if there's any VA disability pay, if there's an outstanding VA loan. It just gives us some information in that regards. It also, if a veteran has been discharged from the military with more than a 10% disability, you'll be exempt from the VA funding fee, which is the next item I was going to talk about, which is VA allows you to do 100% financing, which is great because there's really no other programs like that out there. They don't charge PMI. However, they do have what's called a VA funding fee. And I've put a little chart on here. How much your VA funding fee depends if you've ever used your VA entitlement before, or if you're using it for a second, third, fourth time. And it also depends on how much money you're putting down. So if it's your first use and you're putting no money down, then you'll see that your funding fee would be 2.15% of your loan amount. And that gets, with VA, they allow you to finance that into the loan amount, or you can pay it in cash. Most people end up financing into the loan amount. It doesn't make a big difference in the monthly payment. It obviously saves on cash out of pocket. But the funding fee, that's another reason that we get that certificate of eligibility up front, is to really know about the funding fee for somebody. And from there, there are, like any loan program, there's going to be pros and cons. So what you run into with VA, VA is a great program. Some of the great things about it, like I talked about, is no down payment. There is no private mortgage insurance, which, depending on your loan size, that could be anywhere from, $75, $100 a month to $200 a month. And then they also have some flexibility with lower credit scores. So when you do a conventional loan, for example, they have credit score tiers, and the lower your score is, they basically penalize you with your interest rate. So I'm going to use a very round number. Let's say you have an 800 credit score, you may qualify for a 6.5% interest rate. If your credit score is 700 with a conventional loan, your rate instead of 6.5 might be 6.75. So they have different tiers like that, but VA does not. So they have a little bit more flexibility. And also not only just with credit scores, but credit history. So these loans get run through a computer system that kind of evaluate your income, your credit, all that kind of stuff. So VA has a little bit more flexibility if somebody maybe has an old collection account or some late payments. So that is one of the really big positives with VA. VA also allows a higher debt to income ratio. A debt to income ratio is basically something that a lender looks at, which is your total monthly debts, which would be your new housing payment for the mortgage, any car loans, any student loans, any credit cards. And then we divide that by your gross monthly income. So that's income before taxes are taken out. And conventional loans have a lower threshold for that, where VA will have a little bit higher threshold, which gives you a little bit more flexibility, which is nice with VA. And then from an interest rate standpoint, depending on the day you catch it, sometimes VA can have a lower interest rate than a conventional loan. Part of that equation can depend if somebody's putting a down payment down. If you look at 100% financing on VA compared to a conventional loan putting 3% down, usually a VA loan is going to be a lower rate. But if somebody's putting a larger amount down, they can be sometimes equal. So it can vary depending on the situation. Some of the negatives on VA financing is they only allow VA financing for a primary residence. So if you're buying a second home or an investment property, you wouldn't be eligible to use a VA loan for that. Now, with that said, if you bought a primary residence with VA, and let's just say you're in the military, you're getting transferred, so you're in that house for 3 years, and you go to move out because you're being transferred, you can keep that existing house, and it can change into an investment property. VA does allow that. They just don't allow you to purchase a house up front as a second home or an investment property. But it can become one later. Another negative can be that VA funding fee, because it is a fee that goes directly to VA. There's no benefit to the veteran. It's just something that VA charges that helps fund their program in general. The appraisal process with VA can be a little hit and miss. When you order a VA appraisal, you have to order it through VA directly. They're going to assign it to one of VA's appraisers. So with a conventional loan, for example, when we order an appraisal, we're ordering it through one of our approved appraisers that we deal with all the time. when you go through VA, it's going to be assigned to one of their appraisers. So it's a little, you don't necessarily know the quality of the appraiser you're going to get. For the most part, VA appraisers are fine. They're good. Their turn times can be a little bit slow, which, that can play into, when you're in a competitive market like we are right now, and, it's a seller's market. So buyers need to do whatever they can to kind of make their offer as good as possible. VA, when we order the appraisal, technically the appraiser has 10 business days to get that appraisal back to us from the time that they inspect the property. So, in what we're seeing right now is business has slowed down a little bit because of lack of inventory. So VA appraisers are usually pretty quick over the last few months. But in a very busy market, like during the COVID years of 2021, you could see VA appraisers taking, 2 or 3 weeks to get an appraisal back. So that can be a little bit of a deterrent sometimes if you're trying to do a quick closing. VA does have minimum requirements on properties. So for example, like safety items, if you had if there was a ceiling fan that was removed from the ceiling, but the wires were exposed, that could be an issue for VA. Or if there's chipping and peeling paint around the windowsills is a common one that you can see. VA would require that, where conventional financing would not necessarily require that to be fixed. And lastly, because of some of the things I've mentioned between appraisal and VA repairs, in a competitive market where there could be 5 or 10 offers on a house, if you're going in with a VA offer compared to the 9 other offers are conventional, it could be challenging to get your offer accepted when you're competing. Sellers sometimes they have a thing in their head that VA is going to be a huge pain in the butt. For the most part, they're not. But that's kind of the stigma that comes with VA financing, because over the years, used to be a little bit more painful with repairs and stuff like that. But VA has relaxed a lot of that stuff, but it just hasn't necessarily seeped into the market where, you necessarily have the sellers looking at it that way. So it can, for all intents and purposes, it can prevent you sometimes if you're in a competitive situation. It can hold you back a little bit. So that would be one downfall, obviously. And then just some kind of miscellaneous stuff in regards to VA. I get asked questions a lot. VA financing, can you have more than one VA loan? A lot of people think you're only allowed to have one at a time, which is not true. You can have more than one VA loan. What happens is, if you have an outstanding VA loan now, and you're not going to sell that house to pay that loan off prior to purchasing your next house with a VA loan, depending on how much entitlement from VA is tied up in that original house, we basically pull their certificate, and VA has a formula. We have to plug in your new purchase price, the amount of entitlement that's tied up right now. And what will happen is VA will require you to put a down payment down on the new house. So they'll still allow you to get a VA loan, but instead of doing 0% down, it may say that you need a 5% or a 10% down payment, just depending on how much entitlement's tied up in the old loan and then what the sales price of the new place is. So you can have more than one. It's just there could be a down payment requirement. In this kind of market where it's a little bit of a seller's market, if somebody, I have a client right now where they have some money to put down. So if somebody has some cash to put down and they've kind of budgeted to use it, I will look, when we're doing a pre-approval, I'll look at a conventional scenario and a VA scenario and figure out which one could work out better. And it may come down to, depending on when a customer finds a house, if there's no other offers on the house and they want to go VA, then it doesn't necessarily, that's great and it's fine. But if there's other offers and they have the ability to go conventional financing, typically it may be better for you and put you in a more competitive situation. It will help you possibly get that offer accepted. So, conventional financing is, if all things are equal, can be just as good as VA if somebody has some money to put down. VA typically, makes it more attractive when you're not putting any money down. And another part to help kind of offset, if a seller doesn't necessarily, if they're not jumping up and down to take a VA offer, instead of just stopping at a pre-approval, a lot of times I'll have customers get a credit approval. So we'll actually put the loan in front of an underwriter. They review the credit, income, and assets, and we get what's called a TBD loan approval, because you don't have a property address yet, but we actually have a full credit approval. So when you go to put an offer on a house, the seller doesn't necessarily have to worry about, are you going to qualify for VA financing? Your loan's already been approved. So it just basically can allow you to remove your VA financing contingency because you already have the VA loan approval. So that's something we've done in the past to kind of help combat maybe a VA offer not being as competitive as a conventional offer. We try to kind of take that out of the equation by already having it approved. So there's just some little nuances with it. But that's really, in a nutshell, I mean, there's not VA financing is, it's not super complicated, not a lot different than other financing. It just has some little nuances with it. So that's why we try to kind of button all those things up front, and help the veteran and everybody kind of understand what's their best option. Is it VA? Is it going conventional? And, are they exempt from the funding fee? That kind of stuff. We do all that legwork up front to make everything a little bit smoother and easier as you're looking for houses, or when you find a house to put an offer on, you're kind of prepared and ready to go and you know what to expect. But does anybody have any questions or anything? Or is there anything that I didn't touch on or any questions about stuff I did talk about that maybe wasn't clear?
Yeah, Brian, there are two really good questions in the chat. The first one is there a maximum amount the VA will loan out?
So there used to be, they used to have a max loan amount based on the area that you were buying in. And a couple of years ago, VA got rid of that. So now, and when I say that, what happens is VA is its own entity. So they're going to go out and say, look, you don't have a maximum loan limit for getting a VA loan, but then you have the investors that will purchase the VA loan. And most of the investors will cap you with a no money down VA loan at $1.5 million. If you get over that amount, a lot of times you will need some sort of down payment. But they've really, over the last couple of years, it really widened for VA buyers to go up to these higher loan amounts with very little. Because to put it in comparison, when you do a conventional loan and you're doing a jumbo loan, let's say the county loan limit is, in our area for DC Metro, you could do a Fannie Freddie conventional loan up to just under 1.1 million. Well, if you found a house at 1.3, you could technically do a VA loan and put no money down at all. So it can become very attractive on the higher priced houses because of a lot more flexibility with the lower down payment.
Okay. Other good questions. How far in advance can you get the certificate of eligibility? There's no too far in advance. We can do it. So what happens is when we pull it, say I pulled one today for a customer, and they didn't find a house for say 10 months. Okay. So they get a contract on a house 10 months from now. We would go into VA and pull an updated one because it does have a date on it that will expire. So after, I think it's 120 days, VA requires us to pull an updated one to make sure that, they didn't, that there's not new information on there, like a disability claim was filed or another VA loan was taken out or something like that. So you can always do it. You always want to do it as early as possible. It doesn't cost anything for us to pull the VA certificate. So there's no harm in getting it early as possible. Okay. And does VA do land or construction loans?
So they do not do land loans. There is a VA construction loan that's out there. It is a very rare loan that we actually have Southern Trust is a direct lender. So from start to finish, we control the process, and your loan actually is funded and is with Southern Trust. The VA construction loan, we have an investor we deal with, but it's a broker relationship. The loan itself is very, very quirky. It does give a veteran a way to build a house. It can be expensive though. So sometimes just doing a regular construction loan versus a VA construction loan can be a better avenue, because VA construction loans just aren't super common. There's not a lot of people out there that specialize in them. So that would be they do them, but it may not be your best avenue.
Okay. I'm going to leave the chat there. So if people have other questions, Brian is a wealth of knowledge. We have worked with Brian for many years now. He does all of our VA clients. This is who we refer to. So he really knows the ins and outs. So take advantage of his knowledge here in the chat, and I'll let him kind of keep the conversation going there. And in the meantime, I'm going to flip over and follow up on some of the things he talked about.
but from the perspective of a realtor and using that loan and that information in your search. So let me go ahead and pull up some slides here. And again, by way of introduction, my name's Katie Wethman. I'm with the My Move DMV team, and I have a couple of team members here tonight as well in the chat. So if you do have questions, feel free to drop them in the chat, and either they'll get back to you or I'll come back to them at the end. I only have about 5 or so slides. One thing I did want to touch on when Brian was talking about, the disadvantages about why some sellers don't necessarily like taking offers with a VA loan. And it does come down to the market you're in. I know some of you are looking outside of the DC area, so it may be different wherever you're looking. But in the DC area, it is really competitive. A lot of homes do sell quickly and with multiple offers. And if you are the only offer, then great. They will happily accept a VA loan offer. But if they have the choice of 2 offers that are very similar, and one is VA and one is conventional, that's where it gets a little tough from the seller's perspective. Number one, because of the inspection requirements, what Brian was talking about, some of these little things that are a requirement for a VA loan that a conventional loan does not require. But the other piece of it really is that appraisal. And it's not only the timing of the appraisal, which we can't control in a VA loan, whereas a conventional loan, we do have a lot more control over that. But the other part of that appraisal challenge from a seller's perspective is that in a hot market, it's very common for a buyer to waive the appraisal. Or at least waive the contingency, I should say. So they might get an appraisal, but going forward with the contract, it's not contingent on that value. And by law, the VA loan appraisal cannot be waived. So even if a veteran signs something saying, I agree to waive it, it is not enforceable in our local contract here in the DMV area. So the veteran could say, hey, I don't care, I've got cash, I'm willing to waive it. But the VA technically will not let them do that. So savvy sellers and savvy agents know that to be the case. Now, there are some workarounds, but you need to be working with an agent and a lender that know what those workarounds are to be able to get a seller to agree to that. So that's just why it's important to work with an experienced lender like Brian, an experienced team like ours. So we do have a better than average success rate of getting some of these VA offers accepted. So before I jump into a little bit more information on that, I'm just going to take a quick timeout and share with you this link and this QR code. And this is a feedback link, which it's really important to me and to Brian. We teach these classes pretty frequently and we're always improving on them. And we would love to hear from you about whether this was what you expected to hear, what wasn't covered that you thought would be covered. And this is also a place where you can ask for a copy of the slides. So there's really 2 opportunities to ask for copies of these slides and a copy of this recording. The first is via this feedback form right here in this QR code. And if somebody doesn't mind, if you could just check that QR code or check that link in another window and just drop into the chat, let me know that that is indeed working. It should be. And then at the end of this Zoom, you're going to see a pop-up window asking for feedback. And that is the other place where you can drop in your email address and provide, let us know that you'd like a copy of the slides, and we're happy to get them out to you, both Brian's presentation as well as these few slides that I'm going to go through. So my background, just real quickly, I'm an accounting and finance undergrad. I have an MBA. I've been doing this for a long time, more than 18 years now. I do have a team of 12. And we work across the whole DMV area. It's about $80 million in sales. So that's about 125 transactions a year. So we see a lot. So we work with a lot of different buyers, a lot of different sellers. We do work with both. So we see it from both angles, which is helpful. And then please connect with us on social at MyMoveDMV, especially on Instagram. And we launched a new Instagram account called Homebuyer FAQ. And some of you may have seen the details for this class on that Homebuyer FAQ account. It's an account specifically with Q&A for buyers. So we're hoping to share a lot more in the months to come there. So please give us a follow. So I am actually going to start the process piece of this presentation with the elephant in the room, and that is the recession. A lot of buyers come to us and say, I'm not going to look till next year because I think there's going to be a recession. I think prices are going to come down, and this is not a good time to buy. So I just want to talk at a high level about what's going on at a macroeconomic perspective, and just give you some little things to keep an eye on, because we do actually believe this is a great time to buy, for a number of reasons. First is that a recession does not always equal a housing decline. In fact, it usually does not equal a housing decline. So that infographic on the right is the last 6 recessions that we had. And only 2 of the last 6 had a housing decline. One was very, very small and very short-lived. The other one was the Great Recession of 2008. And we did see a big housing decline there. And the primary drivers of that housing decline were that a lot of people were getting into loans that they couldn't afford, which was not the VA buyer pool. It was the conventional buyer pool that people were getting underwritten when they didn't have jobs, they didn't have income, there were very low teaser rates, and they were being qualified based on those low teaser rates. I'm sure Brian can talk at length about this at the end if people are interested. But there were some very unique drivers of that decline related to mortgage and underwriting that are not currently an issue. The market is very different now. So when you're seeing headlines about a decline in the housing market, we need to be really careful to distinguish, is it a decline in volume and the number of sales happening and the volume of homes being sold, or is it a decline in prices? And what I'm seeing nationally is that there is a big drop in the volume, so the number of transactions, but there is not a big drop in prices. There are some markets out there that are seeing that. The DC metro area is not one of them. We are seeing a decline in volume. And the reason for that is very simple. It's supply versus demand. We do not have a lot of supply in this area. And I'll talk about that in a little bit more and give some examples in a minute. But whatever market you're looking in, you really want to find out what's going on with supply, and then how does that compare against demand, which we call the absorption rate or the months of inventory. So you want to find an excellent local lender who can share those statistics with you. And we do have a nationwide network through our brokerage and some coaching programs we're in, and just our years of experience. So we're happy to connect you with an agent that looks at some of the statistics that we look at, so that they can walk you through this. But supply in our area is very, very low. So we're not seeing a decline in prices because supply is low. So demand is still high, supply is low. So that is supporting the current levels of prices or supporting growth in prices, specifically for some segments like townhouses and detached homes. We're not seeing it so much. Condos are pretty flat, but townhouses and detached homes are still seeing price increases because of the supply problems. Unlike 2008, we do not expect a big spike in distressed sales, so things like short sales or foreclosures, because most of the homeowners today do have a lot of savings coming out of 2020, 2021. They have a lot of home equity because of the run-up in prices that we have seen since 2020 in particular. And then, as I alluded to earlier, the stronger underwriting standards. People can still afford the homes that they're in. They're not being foreclosed on because there were stronger underwriting standards when they bought those homes, unlike people who bought homes in 2005, 2006. And then, Brian can talk again more about this, but there are alternatives to 30-year fixed rates. We do expect interest rates to come down over the next 6 to 12 months, but there are lenders out there with great products. People are switching into adjustable rate loans, things like that. So we have a saying, date the rate, but marry the house, meaning don't put off your home search because of the rates. There are solutions out there, things like buy downs, credits from sellers. The important thing is to get into the house you want when there is less competition now. So once rates come down, demand is going to spike even more, which will make it even more of a challenge especially if you're buying with a VA loan, because a lot of those conventional loan buyers are going to come back off the sideline. So if you've decided a VA loan's the way to go, I'm comfortable with the market. We still have a lot of questions from people. Well, should I rent or should I buy? And so what I want buyers to think about is this timeline. So there isn't a right answer or a wrong answer, but the longer you stay in a property, the more it's going to make sense to buy. And that's because there are transaction costs that we need to recoup. So in our area, generally, you're going to be looking at 2.5% to 3% closing costs when you buy, and about 6 to maybe 7% closing costs when you sell. So when you add those together, the transaction costs on a home are about 10%. So we need the property to appreciate by that amount, or we need you to pay down that amount of equity to recoup those costs. And so for most buyers, that's about a 3 to 4 year time frame that you need to either live in the house or live in the house and then rent it out. So as long as you're owning the house for that 3 to 4 year timeline, it will usually make sense for you to own. And a lot of our VA clients, they're not sure how long they're going to be here, so they might buy it with the expectation that they're going to be in that house 2 to 3 years, but then turn it into a rental 3, 4 or more years. And then for some of our VA buyers, they know that they will cycle back through the DC area. There are lots of bases here. So they'll end up maybe coming back to the Pentagon more than once. And so they'll hold on to that house thinking, I'll rent it out until I cycle back through, and then I'll move back in. And then I'll debate whether or not to keep it or sell it, or turn it back into a rental. So lots of options. I've had VA buyers come back in and their renters are so great that they don't even want to move back into the house that they bought. They buy a second house. And that's a great way to look at wealth building over a 5 or 10 year period. So when it comes to choosing an agent, we are experts in first-time buyers, but we work with all kinds of buyers, second-time investors, so we have an eye for that. We have different people on our team that specialize in different segments, but we're all full-time. I encourage you to work with an agent who is full-time, who has experience in the locations that you're looking, the types of properties that you're looking. I do think teams are the future of real estate. You can see a lot more properties. They can juggle a lot more virtual showings, virtual inspections. So we can manage the whole process for you remotely. If you're stationed overseas, for example, we do that quite a bit. And things like that are a lot harder to do with a solo agent. They also let you see what's happening in the market more quickly, because we, for example, have 12 agents out there writing offers, seeing properties. So when the market does shift, we tend to see it more quickly than other agents who might be a solo agent working with 1 or 2 clients at a time. We're typically working with dozens of clients at a time. So we can see when the market's slowing down or when things are picking up. But whatever agent you work with, and it is perfectly fine to interview agents, we do recommend that you just discuss any minimum commissions that you might be on the hook for, and then also the exclusive buyer representation agreement. So in our area, our rules say that if you do not have a signed buyer rep agreement, then all agents automatically work for the seller. So obviously that's not in your best interest. So typically good buyer agents will ask you to sign an exclusive buyer representation agreement. And it's a pre-printed form with some fill in the blanks. And it is definitely worth a discussion with the agent that you're considering using to make sure you understand that, and that you understand any minimum commission will be in there, the term of the agreement will be in there, and how that agreement ends if one of you decides it's not working out. That will be in there as well. So very important conversation to have as you're interviewing agents. So once you choose your agent, the process is pretty straightforward. We like to jump on a Zoom call like this and discuss the market conditions specifically for the area that you're looking in your price point that you've discussed with a lender like Brian, because the market could look very different at a 300,000 versus 500 versus $1 million. And we can flip some criteria on and off to make sure we're casting a wide enough net so that we're realistic that we can meet your time frame for finding a place. So sometimes buyers are very flexible. There's no specific time frame. Others are PCSing into the area and they need to be here by a certain date. So we need to be realistic for your situation. And so doing a real-time search criteria and search setup helps us do that. So we'll set up that search. We can also set up private tours with you. So depending on your time frame, sometimes we will get on things right away and set up a private tour for as soon as we can when things are going on the market. And again, that private tour could be in person if you're already local, but it also could be by FaceTime or Zoom if you're not local. But we want to get into that property as quickly as possible because sometimes the market does move really quickly. You also have the option to do open houses, but if you are on a deadline to move, we recommend that you set up these private tours with us because often homes will either sell before the open house. So for example, just this past weekend, I had one with a buyer who it came on the market, the property they were interested in came on the market on a Thursday. Now we had a heads up because we were also searching the coming soons. And that's the other reason we like to talk to buyers very early in their search process because we can look at the coming soon pipeline. So we've known for 2 weeks that this property was coming. So we set up an appointment to see it for the day after it came on the market. They had conflicts. They were out of town on the Thursday that it actually went active. So we saw it Friday morning, first thing. They loved it. They wanted to write an offer, but they wanted a home inspection. So we scheduled an inspection for 8 a.m. Saturday morning before the Saturday open house. Then we wrote our offer and we were able to write it non-contingent because they had that pre-offer inspection Saturday morning. The sellers decided to go through the Saturday afternoon open house. They already had one offer in, then we submitted our offer. They decided to cancel the Sunday open houses and just choose between those two offers, and we were able to get it. And part of the reason we were able to get it was because we had done that pre-offer inspection Saturday morning. So the only reason we had time to do all of this was because they had worked with a lender, everything was in place. We saw it coming soon. We had the appointment set up and we had relationships with inspectors that we could get them in there the next day. So this search could be a couple of days, it could be a week, or if you're more flexible, it could be many months. It's really up to you. But the more time we have, the more notice we have, the better. So that offer due diligence process, it could be very quick. Like in our case, it was 48 hours. We did the inspection. They actually waived the appraisal. They got a waiver for it. They were doing a conventional loan and that qualified for a waiver. So they didn't need an appraisal. They had all their lender paperwork in, so they didn't need a financing contingency. So it was literally 48 hours between seeing the property and having a ratified contract with no more contingencies. So it can be very quick, or if you're the only offer in and there's some negotiation, it might take a week or two. And then the closing is generally 30 to 45 days. If you're using a grant program, which most of the people on this call would not be, it could take 60 to 90 days. But generally with the VA loan, and Brian, maybe you could comment on this at the end. I think it's generally 30 days, but when the VA is really busy, sometimes we need a little bit of extra time. So I wanted to, this graph is, and apologies for anybody not looking in the DMV. I just wanted to throw a little bit of data out here for the locals about this inventory problem. And this is why we need people to get ready in advance and get that paperwork in and be ready to rock with your lender and see properties quickly, because this is what's been happening to the supply in Northern Virginia over the last 6 or 7 years. It's been getting lower and lower and lower. Now, 2023 is just ever so slightly higher than 2022. So sometimes you see headlines like it's 37% increase in inventory. Well, that's true because last year was so horrible. But the important thing is it is still only 0.7 months of inventory, meaning for every buyer out there, there are 0.76 houses to choose from. So there are not enough houses. And so this is why it's really important to get ahead of the curve with the VA loan and your search process. So let me just make sure I covered everything here. So searching online and in person, you'll meet with your agent, set up a search plan. We talked about seeing listings in person quickly, and just be careful calling the listing agent. They do work for the seller. They do not work for you. So while they can't lie, that is against the code of ethics, but they do not need to share things with you that are against the seller's best interest. So the way to get the information that you need is to have your own agent. So I think we talked about a lot of these offer and due diligence scenarios. Deadline scenarios are common in our area, but the individual situation really is the most important. There was no way to predict, for example, in my weekend scenario, that that seller could very easily have set a deadline and said, I'm not going to look at offers till Monday. For whatever reason, they decided by Saturday night they had had enough. They had 2 good offers. They were going to take one of them. Now, between us, they could have gotten a lot more money out of us if they had waited till Monday. But for their situation, they decided they wanted to be back home. They wanted the process done. They didn't want any more showings. So, it's a good thing that we got our offer in quickly. So the individual situation really is the most important thing to consider. But in your offer, we will talk about the pricing, the terms, and any contingencies. The most common ones are the inspections, the appraisal, and financing. And if you are buying in a community with an association, you do have a document review period, and you can void the contract during the term of that document review period. In our area, it's 3 days. So then we go to closing. Who pays the closing costs upfront or is negotiated upfront as part of the contract. So if you're going to ask for a contribution towards closing costs, we need to do that back at the beginning when we write the offer. So that's another part of the conversation with the lender. Do you need closing cost assistance? Because if it is, we need to write that into our offer. Closing, again, generally 30 to 45 days, unless you're using some sort of grant program. The lender will give you a closing disclosure just prior to closing, so you'll know exactly how much money you need to bring. And then the occupancy date is set by the contract. Generally, it is the closing date unless the seller has asked us for a rent back. And rent backs are an opportunity for the seller to stay in the process. Generally, they will pay you a small fee to stay in the property for up to 60 days. And that gives them a chance to take your money to go buy at their next house. So they don't have to move twice. They'll stay in the property for a short period. And that, again, is negotiated upfront. They don't automatically get that. That's part of the negotiation. So if that timing doesn't work for you, then we just tell them, no, that's a deal breaker for us. And we work that out upfront. So here's my information again. Here's that feedback link. I don't see any questions, but I know, Brian, there were a couple of things I alluded to, and then there's one other question came in about whether or not you can include home renovations in the initial loan or if there's a separate loan. So if somebody wanted to use their VA loan, but they wanted to take out an additional loan for some renovations, is there an option to do that?
Yeah, VA doesn't offer a renovation loan. So you kind of have 2 possibilities. One would be if they have some money to put down, instead of putting, say, 5 or 10% down, they do 100% financing with VA, hold on to their cash and use that for the renovation. So they just basically self-fund it instead of putting the money down. And the other one is that if, using a very round number, if they were buying a house for 400 grand and it happened to appraise higher, and we know that there's some built-in equity, they could always, after closing, go try to get a line of credit as second mortgage to use to fund renovations. But VA doesn't specifically have a renovation loan.
Okay. Any other questions? Okay. Well, we're coming up on our time anyway. So again, would really love that feedback. You'll get a pop-up window when I end the Zoom here. I hope this information was helpful for everybody. This is the first time we've done this class, so the feedback is especially important. And we appreciate you guys being here. Brian and I would both love the opportunity to work with you in your home search. Feel free to use us as a resource, anytime, even if you're not looking till next year. We're happy to be a resource between now and then. So reach out anytime. So thank you so much, everybody. Take care.
Thank
Thank you
you.
very much.
See you guys.